Good evening. We begin tonight with the US Treasury, which has stepped in to calm the bond markets and address a relentless rise in borrowing costs. Yields on the 10 and the 30-year Treasury notes, bonds, retreated after the US government said it would double its buybacks in coming months. This is known as twisting the curve. The reason is the 30-year yield had hit its highest level in nearly 2 decades on Tuesday. And the benchmark 10-year bond, which influences mortgages, is near the highest it's been since Donald Trump returned to office. The president says he's not concerned about the recent bond sell-off pushing yields higher.
Americans be concerned about this volatility in the bond market?
No, I don't think so, because like I said, our country is doing so well despite interest rates. We have interest rates that are they're actually artificially high.
Right. The Treasury's buybacks are dwarfed by the completely staggering amount of US government debt at the moment. Think about this. So have a look at this. This, excuse me, this is you and me as the investor. Excuse me, when you buy a government bond, you are essentially giving the government an IOU. And as the government borrows more and more, those loans become more risky. So the investor, that's you, demands more and more and more and higher in terms of yields, pushing them up. That means overall, the government has to pay more to borrow. Now, this is all very well known, and indeed, this has been going on for years. Money going that way, interest going that way, coupons going that way, money going that way, backwards and forwards. The only problem is that the US national debt has just hit $40 trillion, and the interest payments alone come to roughly $2.3 million per minute. We've been on air 3 minutes and 30 seconds, so you can make that of what you will. Few people know the bond market better than Mohamed El-Erian, who joins me, the Chief Economic Advisor for Allianz. This is interesting because this is classically twist the curve. By buying at one end of the yield curve versus the other, you're hoping to artificially shift but it's a very short-term strategy.
You're absolutely right. It's known as Operation Twist. It's been done in the past. The more formal name is yield curve control. And why is it happening? Because the administration is worried about what higher bond yields at the 10-year point, at the 30-year point, as you pointed out. What does that do to the mortgage market? What does it do to corporate borrowing? What it does, it makes mortgages more expensive. It makes it harder to fund a home, and it adds to the affordability problem. So what do you do if you can't address the fundamental problem, which is too much government debt and deficits and too much borrowing by tech companies? You start financial engineering. You buy the long end, meaning you try to bring down longer term yields that impact most mortgages, and you sacrifice the short end. And with that, you take a risk to the functioning of the liquidity markets. So it is think of it as a circuit breaker. It works in the short term, but it's not a free lunch.
Oh, but you just put your finger on the problem with it all, which is you are doing financial engineering. You're actually doing nothing to change the fundamentals upon which these markets are trading.
That's absolutely correct. You're buying time. Now, why do I want to buy time? There's a political argument. The midterms are coming up, and affordability is on voters' mind as a really important issue. But there's also an economic argument, which is that the bond market is funding about 800 billion of borrowing by these tech companies this year. And what are these tech companies going to produce, we hope? Innovations that increase productivity and growth. So they're trying to bridge to a new world, and they're trying to minimize the journey, the bumpiness of the journey to that new destination.
Have you known incidents where this has worked and worked successfully? versus those occasions where it's been a band-aid but has eventually all gone horribly wrong?
It is a band-aid. It doesn't necessarily need to go all horribly wrong. It makes me uncomfortable, to be perfectly honest, because you're intervening in the most important financial market in the world, and you've got to be careful of what you do. We have the experience of Japan that tried a more extreme form of yield curve control and paid the price for that.
At the end of the day, the one big beautiful bill, the various other government policies that have been put forward, they're all just heaping more debt and more debt onto the US balance sheet. I mean, we can slice it any way, which way we like. There does not seem to be, and I'm not making a political point here, Mohamed, any more than you are, but there does not seem to be any credible move towards deficit reduction.
And that is a big problem. I mean, the numbers are stunning. You said it. 40 trillion, the total debt, the highest relative to GDP, relative to what the US produces since World War II. Interest payments eat up 20% of tax revenue. So you give up a fifth of your tax revenue immediately each year simply to pay contractual interest. And we're still running a deficit of 6%, which is unheard of when we have such low unemployment. And if that's not enough, we have debt that we incurred at lower interest rates that needs to be refinanced. So yes, this whole cocktail is where we say, until now, the markets were relatively calm, but what has tipped them over and required this incredible intervention from the Treasury Department is that somebody else is also asking for investors' dollars, and that is the big hyperscaler.
That's fascinating, isn't it? That is a big new wrinkle into all of this. Mohamed El-Erian, I'm very grateful putting the argument forward from the bond vigilantes. Thank you, sir.